Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. Until recently, there were two key patterns here. Now there are three. The first and larger one is the February 2021 to July 2022 ascending broadening wedge pattern. Currently 743.5 to well up off the top of my daily chart, far enough that it becomes immaterial. It is highlighted on my daily chart in blue. This was not a perfect pattern, but it had been the main market driver higher in the earlier part of this year. The break lower in July left the following incredible targets on the downside. The primary target X is in the 352 even area, with a harder to reach secondary target X1 in the 217 even area. These are obviously, pretty much way out there targets that you can put into your diary on the back page and just look at them maybe once or a year or so. The second smaller pattern was in development until the end of September, and on the surface seems a more reasonable opportunity. It was created from the break lower of the larger pattern in June and July and is an optimized falling wedge pattern, currently 564.5 to 546.5. I've highlighted the falling wedge pattern in red. The key features in this pattern have been the temporary halt to the decline at the February low at 599.75 back in August, the earlier breakdown through the 50% Fibonacci line of the April 20 to April 22 move of 644, the false break lower in mid-September below the lower trend line, and above all of these, the break up and out of the falling wedge pattern at the start of October. This break higher continues, sort of. It ran into a lot of headwinds on its attempts higher during the earlier part of October and currently seems to be attracted to the duo combination of the 50% Fibonacci line of the December 2020 to April 22 move at 643.75 and the medium moving average, currently 641.75. Now, before I start recapping possible upside targets for this pattern, that I'd previously set out anyway, I'd like to reiterate something I had said here these past 5 weeks, and it is important. There's a key problem with this pattern. It has been created in the wrong place. By that I mean it should have been formed after we'd had a prior ascending pattern, not as in this case after a great big gapping drop lower. This had previously led me to suspect that perhaps this pattern may morph further along into something else. Until recently I had not noted anything special, but last week I was minded to look at the action as a third pattern. A late June to date, very big V-bottom type pattern, an extended V-bottom with a flat hesitation area formed during October, which may be extending into November. This pattern gives potential up to the 690 area, and it would be in part tie in with potential upside targets for a break higher from the falling wedge pattern. Thus a primary target X2 would be in the 702.75 area, and a secondary harder to reach target X3 would be in the 757 even area. Last week the market broke up over and started to stabilize the 50% Fibonacci line of the December 2020 to April 2022 move at 643.75, which had earlier been a stubborn stain that didn't seem to want to move. We also had coming in from above the declining medium moving average, currently 641.25. This had been in effect a new resistance that hadn't been tested since June, so I was previously cautious when mentioning it. However, prices hesitated last week and this week have moved lower down to the comfort and security of the 50% Fibonacci line at 643.75 and the medium moving average. Nevertheless, just in case, we seem to have little on the way topside until the mid-August high at 671, which was also where the market peaked just under last week. Now, my only concern is that the hanging around here for too long and the market may start giving up the nascent bullish incentive and start seeing disappointed longs liquidating positions. Winnipeg canola. Whilst the September 2021 low at 839.20 and the August 21 low at 817 both acted to halt the declines in late June and early July, it was originally the 50% Fibonacci of the October 2020 to April 2022 move at 863.80 that triggered the retro reverse engines to pull prices up, all the way back up in late June, which is kind of ironic as it has during most of October been acting as a support for an attempt higher. Now, going back to the summertime for a moment, it became evident since the start of the sideways to slightly lower movement we've seen here since June that there was a shallow bear channel, basically, currently 774.70 to 875.10. And it is this that had been driving the market lower during the summer. To emphasize this point, I'd like to recap some of my commentary from 2 weeks ago, and I quote, "So it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market." This leads us to what has happened since mid-September today, where we had a nice rally from the bottom of the bear channel, reaching the upper bear channel line at the start of October. Since then, we have been confined between the upper bear channel line and the 50% Fibonacci line at 863.80. This situation cannot last, even though ranges could narrow into the start of December. I suspect an event will take place that will trigger a move before then. End of quote. Well, it looks like that event may have happened last week, with multiple consecutive closes over the upper bear channel line, and the whole of October's action being roughly 863.80 to 880 even. This zone is now support. This leads again to something I highlighted 2 weeks ago, and I quote, "So what is there left that could influence the market?" Well, I'd previously discussed the idea that perhaps, just perhaps, the mid-September to date action is in the form of a rather flat bullish halfway hesitation. I'm not altogether happy with this, but it may just fit. If it does, and it is way early so far, then we could be looking at a move up to the 960 even area. Mind you, at this time, it could quite easily be a topping action, and we see the lower bear channel revisited once again. And that's the end of the quote. Last week on this, the market was seriously taking this idea of a flat bullish halfway hesitation. So what do we have overhead that may impede the move higher? Well, the obvious ones are the highs of October at 898.5, July at 904.30, and late June at 912.70, plus I'd add the 50% Fibonacci line at 921.70 of the January 2021 to April 2022 move, though this one did not show any support on the way down back in June. We then have congestion at 945.10 and 959.80 before we get to the 960 even number. I would also add that just above that, we have the slowly declining long moving average, currently at 969.60, which is slowly entering the frame. One final feature to put into this mess, and that is the action over last Thursday, Friday, and this past Monday. The three indecisive spinning tops formed over those days made what is referred to as a three-session bearish tri-star pattern. Not an uncommon pattern, but not that uncommon. Now, it is called bearish, but there is some significant debate on this, as something like half the time they turn out to be bullish continuation patterns. So, just keep a close eye on those three for the next few sessions. Bursa Malaysia crude palm oil. Superficially, you might think the break higher over the short medium moving average, currently 38.67, and highlighted in green on my daily chart, was a key moment in the move higher in recent days, and you would be partially right, but not wholly. You see, over September and mid-October, the market had formed a small but effective reverse head and shoulders pattern, which I've highlighted on my daily chart. And it was a combination of the break higher over the neckline of this reverse head and shoulders pattern, as well as the old neckline of September 2015 to November 2017 head and shoulders top, currently 38.62, which is also highlighted but in red, and finally the break above the short medium moving average that together caused the move up since mid-October. This move higher gave potential targets on the upside of a primary target X in the 42.45 area and a secondary harder to reach target X1 in the 44.40 area. Last week prices reached target X and came close to target X1 as well, but finished with a shooting star pattern. Now, it raised the interesting question at the time, of whether the shooting star pattern was a type 1 bearish or a type 2 bullish. Initial indications suggested a type 1, and after some hesitation, the market followed through with this bearish action. However, yesterday it seems at the moment, but seems that prices have moved down as close to the slowly declining medium moving average, currently at 40.07, than they are willing to go. However, the question may still just be open. Yet if prices do turn back up, then the first obstacle would be beyond target X1, at the previous all-time high formed in March 2008 at 44.84. There is then quite a sparse area above until a band made up from two 50% Fibonacci lines. They are the 50% Fibonacci on the July 2019 to March 2022 move at 49.64 and the 50% Fibonacci line of the May 2020 to March 2022 move at 49.92. Beyond these, we have the slowly declining long moving average, currently at 51.83, which is far enough away to cap any likely immediate rise. The question remains whether the market will continue its rise and what will it do at the March 2008 previous all-time high. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.